शहजाद भाई। शहजाद भाई। हेलो शहजाद भाई।
Yes, sir.
या माय वॉइस इज ऑडिबल?
Yes, sir. Perfectly audible.
ओके।
Yes, sir.
शहजाद भाई।
हाँ सर, आपका आवाज़ इको हो रहा है.
हेलो शहजाद भाई।
Yes, sir. Yes, sir.
या माय वॉइस इज ऑडिबल?
Yes, sir.
Yes, sir,
Perfectly audible.
perfectly audible. Oh.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता
Esteemed speaker for today, Senior Advocate Saurabh Sopakarji, Chairman Ahmedabad Branch CA Harit Dhariwal, President Chartered Accountant Association CA Monish Shah, Vice Chairman CA Bhishan Shah, Vice President Chartered Accountant Association CA Sarju Mehta, senior members and my dear friends, a very, very good evening from the Secretary, Dr. CA Anjali Choksi. Welcome to this second session on Union Budget 22-23. And Ahmedabad Branch and Chartered Accountant Association are always grateful to the Honorable Senior Advocate Saurabh Sopakarji to continue this tradition. And if I'm not wrong, Ajit, it has been more than 18 years that this tradition, we are really grateful to you, sir. Thank you so much. I would now request Chairman Ahmedabad Branch C. Harit Dhariwal to give his welcome address.
Thank you, Anjali Ben. Am I audible? It's okay.
Yes.
Yeah. Very respected Senior Advocate Shri Saurabh Sopakarji sir, the President of CA Association, CA Monish Shah, Vice Chairman Bishan Bhai, Secretary Anjali Ben. From the CA Association, I can see Dr. CA Sarju Mehta, the Vice President, Rushabh, Jay, and the other office bearers of CA Association, and all the other participants who are attending this program. Yeah, am I audible now? I think this.
Yes.
Yeah. All the participants that are attending this program, a very, very good evening to all of you, and welcome to this much-awaited session on the budget analysis. As they say, the budget in Ahmedabad is incomplete without the analysis or inputs by Shri Saurabh Sopakarji sir, and we are very happy that today he's taking this session in front of all of us. Today is his time. I will just brief you about a few advanced initiatives in Ahmedabad branch. But before that, I think let us all put our hands together and clap for ourselves, because Ahmedabad branch has been adjudged the best branch of the country at national level for both the members and the students. And yes, we have also been adjudged the best branch at the regional level for members and students. So all the top 4 awards we have got at Ahmedabad branch, and I'm extremely thankful to all the members, students, and all the support staff for this wonderful work that they have done throughout the year. I would not take much of your time. I would just again thank Saurabh sir. As Anjali was saying, 18 years straight, I think budget discussion without your analysis is incomplete, sir. So thank you so much, sir, for sparing your valuable time. And over to you, Anjali Ben. Thank you.
Thank you, Chairman, for giving a good start to the session. I would now request President Chartered Accountant Association, CA Monish Shah, to give his welcome address.
A very good afternoon to everyone. Happy Vasant Panchami, first of all. I congratulate the Ahmedabad branch of the WIRC of the ICI for receiving the best branch for members and the best branch Vikasa, both at the national and the regional level. The Chartered Accountant Association Ahmedabad was established in the year 1951 and has completed 71 years of its foundation. It is celebrating its platinum jubilee this year. Its unique way of learning, discussions, representations has kept the association becoming one of the premier associations of the country. Journal, its monthly mouthpiece, has been one of the most read books for gaining knowledge. The efforts of the past president and seniors have made this a possibility. Union budget analysis of the association has been done for almost 45 years. The Ahmedabad branch also has joined with the association in this activity, and this has become one of the most awaited programs. It is believed that, as everyone has said, that till the time we haven't heard from the respected Saurabh sir, the analysis is incomplete. The budget was announced, and to analyze this whole speech in such a short time is incredible. In spite of his throat issues, Saurabh sir has accepted our request at the very first go, and it has been very kind enough of him to accept our invitation and be with us here today. Welcome, sir. As Diana Bohar said, if you can't write your message in a sentence, you can't say it in an hour. Even Nirmala Sitharaman ji kept the budget speech this year to a minimal. And following the trend set by her, I shall also keep it short and put an end to my speech. Now I will request Anjali Ben to take over.
Thank you, Monisha, for that kind words. I would now request Vice Chairman C.A. Bhishan Shah to introduce the esteemed faculty for today. Sir, I know you don't need any introduction. We are all proud of you. Just 2 lines for you, sir.
Sir, it is a ritual for every chartered accountant, tax professional and advocate to attend budget meeting of senior advocate Saurabh Soparkar, sir. Sir, due to virtual high courts and its telecast, we all are able to witness your court craft, patience, and unmatchable expertise in the field of taxation. A tax stalwart from Ahmedabad. During his speech in 1972-73, respected Nani Palkhiwala sir said that it is not possible to become wealthy in India by possessing mere ability, industry, and enterprise due to tax exorbitant. Then what will be the next? I hope that with this budget, we achieve a stage in our economic development where it's possible to get wealthy in India through ability, industry, and enterprise. With these words, I request all to give a big round of applause to our learned faculty, Senior Advocate Sri Saurabh Soparkar, sir. Thank you.
Thank you, Bhishan bhai. I would now request President Chartered Accountant Association along with Vice Chairman to welcome our guest with a moment. Now request Vice Chairman C. Bhishan Shah. Welcome our guest with a memento from Ahmedabad branch.
Before Saurabh sir starts to deliver on his analysis on the budget, it's always been a trend that the Chartered Accountant Association has released the budget booklet, which is a short synopsis of the budget. The publication committee has a memo task the moment the budget is released to prepare the budget booklet. I would like to congratulate C.A. Shailesh Shah, the chairman of the publication committee, along with the convener, C.A. Chintan Doshi, and the publication team, C.A. Ajit Shah, Atul Shah, CA Ashok Kataria, CA Ashwin Shah, CA Prakash Sheth, CA Radni Shah, CA Jignesh Bhai Shah, CA Nirav Choksi, CA Rutvit Shah, CA Priyam Shah, CA Puneet Prajapati, CA Riken Shah, CA Shivang Choksi, and CA Manthan Khokhani, who have put in a lot of efforts in making this booklet. I would also like to thank CA Mukesh Bhai Khandwala for letting us use his office and infrastructure to ensure that the budget booklet is ready in time. I also thank Pratiksha Printers who have printed the book well in time. I'd like to thank KD Hospital and Investor Point for their financial support in publishing this budget booklet. I would request CA Saurabh Bhai, I would request Saurabh Bhai to unveil the book for the public. I would also request CA Shailesh Bhai and CA Chintan Bhai to come on the dais for the unveiling of this book. This budget booklet will be available to the public from the CA Association office at Darshak building from Monday 4 p.m. The same is available in 2 languages, Gujarati and English, at a price of ₹15. So those who want to purchase it can please visit the Chartered Accountant office. And those who have pre-booked, they will also get it at the same time. Thank you.
Good afternoon, friends. It's a pleasure to be here this afternoon to share some of my thoughts on the Finance Bill 2022. But before I really begin my talk, I must compliment the publication team, Shailesh Bhai and the whole, Shailesh Bhai, Shidoshi and all members of that committee for taking steps to come out with this publication in such a short time. I have found this publication to be of great use to one and all. With this, let's start with the topic proper. Before I really get into the clauses of the finance bill, we must also consider the historical background as to why the Honorable the Finance Minister did what actually she did. India has been passing through a very difficult phase. Since last 2 years, the government had to spend significant sum of money towards corona, both treatment, hospitalization, vaccination. Economy also has not been, therefore, in between. It had not been doing well. The government requires funds, but the scope of increasing the funds is also very limited. Under the circumstances, I must compliment the Honorable the Finance Minister for not succumbing to the pressure from socialist sectors for introducing wealth tax or estate duty law, which was always hovering on the minds of a lot of people during the budget times. And from this perspective, if we see, we find that she had no option but to continue with the rates of income tax. So the first thing that we need to discuss is that rates of income tax have remained the same, barring one exception, which is a very positive exception. Surcharge payable on long-term capital gains has been brought down to flat 15%, which would mean that those who have income in excess of rupees 5 crore in relation to the capital gain would not have to pay now surcharge at a rate as high as 37%. Normally what I do is I only pick up important amendments for being discussed. This year we have more than 87 amendments. The Honorable Finance Minister's speech was brief, but the finance bill is not very brief. And therefore, if I were to discuss each and every amendment, it would be impossible for us to really finish within a reasonable period. In any case, a large number of amendments are either SSE specific or in relation to situations which are not being faced generally by the practicing chartered accountants. I would therefore restrict myself to only those provisions with which we are likely to be confronted in our day-to-day practice. But before I again go into the specific changes, one, a non-amendment, which is of a significant importance. All of us are aware that last year, the provision for reopening underwent a significant change. And large number of notices were issued by the government after 1st April, after 31st March 2021, up to 30th of June 21, under the old provisions of section 147, 148. Questions have arisen as to whether post 31st March 2021, notices can be issued under the old act. Delhi High Court, Allahabad High Court, Rajasthan High Court, all have struck down these notices. Gujarat High Court has heard the matters, judgment is awaited. There was a strong belief that the government will bring in a retrospective amendment so as to validate all these notices, because notices are thousands in number and the stakes involved is supposed to be running into few thousand crore of rupees. Surprisingly, this amendment is not brought about, which would mean that these notices continue to remain vulnerable, and in my view, they would be illegal. And therefore, I don't know why, but government has chosen not to take a step so as to regularize those notices, which in my view are illegal. Therefore, this is a first change, which is not a change, but it is an important thing which I wanted to share with you. Let me now go to the few important changes. Cryptocurrency has always been a matter of some debate as to whether or not it is legal, how to take care of it. The government is thinking of regulating it, and there is thought process back and forth on how to deal with it. Apparently, the Honorable Finance Minister decided that instead of waiting for the stance on the government as to how to deal with this cryptocurrency and such virtual assets, now that that parallel economy is huge in size, which is not being tapped for the purpose of taxation, let me now bring in an amendment or a set of amendments to tax these currencies. So now we have a new asset, virtual digital asset, defined under section 2, clause 47A. It's a long and complex definition. Effectively, cryptocurrency and all such virtual assets are covered under section 247A. Any income on sale of or on transfer of such virtual digital asset is liable to be taxed at the flat rate of 30%. In as much as it is liable to be taxed at the flat rate of 30%, whether it's a capital asset or a business asset, long-term asset or short-term asset, everything becomes irrelevant because tax is being charged at the maximum rate. For the purpose of computing income in relation to virtual digital asset, the further provision is barring cost of acquiring the asset, no other expenditure would be allowed to the SSC. Not only that, if during the year there is loss on transfer of such virtual digital asset, that loss would be a dead loss and would not be permitted to be set off against any other income. Not only it will not be permitted to be set off against any other income, it will also not be permitted to be carried forward in future. In other words, it becomes a dead loss. Interesting questions of law will arise, and I am sure government will have to clarify. What happens if in a year there are two transactions in relation to this virtual digital asset, one giving, say, income of rupees 20 lakh and another giving loss of rupees 25 lakh. The law says, I will not be permitted to set off this loss against any other income. Does it mean that even income on the first transaction of rupees 20 lakh, which is a transaction of virtual digital asset, that also would not be permitted to be set off? Or the virtual digital assets are to be treated as one class, they are to be put in one basket, and the effect of the basket is, if there is a gain, tax at 30%, if it's a loss, ignore it. My view is that if the two sets of transactions are interconnected, I'm very clear there would be no difficulty. But if the transactions are not interconnected, and if it is felt, YouTube channel, okay. And if the transactions are interconnected, there would be, in my view, no problem. But if they're completely unconnected transaction, language used by the proposed amendment is likely to create complications if SSC, and in my view, legitimately seeks to set off loss against the income under that particular very head. Section 56 is also sought to be amended, whereby if a person receives by way of gift such virtual digital asset, he would have to pay tax on the value of virtual digital asset. And finally, to cover up regulatory issues, anyone who pays any amount to another in relation to virtual digital asset will also have to deduct tax at source at 1%. I'm told that even 1% will result into recovery of few thousand crore for the government, considering the size of the market. Therefore, this is one major amendment in relation to virtual digital asset. Let me now go to next clause, which is proposed amendment of section 14A. Now, we are all aware of the law, which is obviously law on account of interpretation by various courts, that section 14A, which provides that no expenditure incurred for the purpose of earning exempt income will be allowed, would be applicable if and only if I have an exempt income. In other words, if I do not have exempt income, section 14A itself will not apply and there will be no disallowance of any expenditure. Now, proposal is that this provision be amended so as to provide that even if you have no exempt income, expenditure that you would have incurred for the purpose of earning exempt income would be disallowed. Now, I have no problem with the amendment. You have a right to make an amendment. The problem is the amendment is proposed in a language for the removal of doubt. It is hereby clarified that notwithstanding the provision of this section, the section shall be applied and shall be deemed to have always applied even when there is no income which is exempt from tax. So, notwithstanding anything contained hereinafter, for the removal of doubt, it is clarified. Mark two phrases: for the removal of doubt and it is clarified. Whenever a law reads for the removal of doubt and or it is hereby clarified, it's always open to raise an argument that even in relation to a period where this amended section was not on statute book, if you are interpreting the section, you will have to necessarily go by the amended section because amendment is clarificatory in nature. Now, Supreme Court has held more than once that even though you may use the language in the amendment for the removal of doubt and that it is clarified, if there is no doubt and if there is no clarification is required, merely by putting that language, you cannot say that the provision is clarificatory and would apply even to the past period. But that again is a matter of debate. And therefore, I seriously apprehend that all section 14A matters, wherever they are, would now also we have to face one more hurdle of this amendment, which so to say seeks to say that if there is no exempt income, section 14A will be applied and the whole expenditure will be disallowed. Government, if it wants to bring in law retrospectively, it can do so. When we go to some other provision, we will see it has done so. This is a half-hearted attempt to bring in an amendment prospectively, but giving it a color of retrospectivity, which again is one more area of unnecessary litigation. One more amendment under section 37. This amendment is also proposed for the removal of doubt. It is hereby clarified. So again, what I said just a little while ago about the litigation about whether it will apply to past period or not would apply even to this amendment. Now, what is this amendment? Section 37 of the Act says it's a residuary section. Expenditure incurred for the purpose of earning income would be allowed to the SSC. An explanation was brought in by which it was provided that an expenditure incurred for the purpose of, for an illegal purpose or which is not permissible at law would not be allowed as a deduction. This amendment is essentially to hit pharma sector. Let me deal with the second proposal of the three. First, to the need. Pharma sector is known, and I am not having any value judgment, but is known to have spent huge amount year after year in distributing gifts, promotions and material, sponsoring tours, giving freebies to the medical faculty and persons connected with the medical field. Revenue sought to disallow this expenditure on the ground that Medical Council of India had come up with the guideline which prohibited doctors from receiving any such sum of money. There are some observations of Punjab and Haryana High Court taking a particular view. Based on that, revenue has always been contending that freebies must be disallowed. Some tribunals took a view, and in my view correctly, that these guidelines apply to the payee doctors. How am I, the SSC pharma company, concerned? So far as pharma company is concerned, it is committing breach of no law, and therefore the expenditure cannot be disallowed. Therefore, the first proposal is, now, so as to complete the narration, recently Mumbai Tribunal doubted the correctness of that view, referred the matter to a special bench that is still pending. But in order that this issue can be put at rest in favor of revenue, this amendment is being proposed. And as I said, the language is for the removal of doubt. It is hereby clarified. The proposal is that if any SSC provides any benefit, perquisite, in whatsoever manner to a person, whether or not carrying on business or profession, in any form, which is in violation of any law, rule, regulation, and guideline, as the case may be, governing the recipient, in that case, the expenditure would be disallowed in the hand of the payer. So I make a sum of pay. Let's say I pay some amount or I incur some expenditure. I am committing breach of no law, rule, regulation. But the person who receives it is committing breach of act, rule, regulation, or even guideline. The proposal is that the expenditure would be disallowed. Now, the term guideline is extremely wide. Which guideline? Whose guideline? Probably one will have to restrict it to the statutory guidelines being issued by statutory bodies. But be that as it may, amendment as it stands, even if it is not taken to be of a clarificatory nature, is now going to hit all these expenses being incurred essentially by pharma company. Two more amendments are also being proposed along with this under this explanation, which effectively is to deal with one matter which is recently decided by Ahmedabad bench of ITAT in a pharma company. Questions that arose were, the pharma company had to pay a significant sum of money running into a couple of 1,000 crore of rupees in a foreign jurisdiction, because apparently there are allegations that it has committed breach of the foreign law. Some amount was paid and some compounding was done. The case of the SSC was section 37, when it says I have to make the payment in accordance with law. Law means law of India. Foreign laws are not really laws covered over there. Following an earlier order of Mumbai Tribunal, Ahmedabad Tribunal took the view that law means only Indian law and not the foreign law. Proposal is, again, so to say, in the language which is clarificatory, to amend the law whereby two situations are being captured. One, when an SSC incurs an expenditure for a purpose which is an offense or which is prohibited by law for the time being in force either in India or in a foreign jurisdiction. That's first situation. Or the SSC incurs an expenditure to compound any offense in any law for the time being in force, again in India or in a foreign jurisdiction. In either case, the amount so spent would not be allowed as a business expenditure. Therefore, this is again expanding the scope of disallowance under section 37 by creating exceptional situations. One amendment under section 40, which was probably both required and justified, is according to Rajasthan High Court in the case of Chambal, followed by Bombay High Court in the case of Sesa Goa, educational cess and surcharge would not be regarded as tax within the meaning of section 40. And because they are not tax within the meaning of section 40, expenditure, cess and surcharge would be allowable as a business expenditure. This was never the intention of the legislature. On account of these judgments of the High Court, large number of litigation started at different levels, and large number of SSs got benefit from the tribunal or CIT appeal. Now, law is being amended retrospectively from AY 2005-6 to the effect that tax would also include educational cess and fees. So no SSC will get the benefit of the judgments of Rajasthan High Court and the Bombay High Court. One small amendment in relation to Corona. Section 56 is being amended. You are aware that under section 56, if an SSC receives any sum of money from any person other than relative, the receipt is taxable. Two exceptions are being created. One in the event of death, another other than death. Both in relation to Corona. First situation says, if an SSC receives a sum of money from any person on account of expenditure incurred by him, either on himself or from his family member for medical treatment in relation to Corona, amount so received subject to certain conditions will be exempt. Similarly, in the event of death, the provision is if the family receives a sum of money from the employer of the deceased, whole amount, or from any other person, related, unrelated, to the extent of rupees 10 lakh, the amount will not be taxable at all, provided that payment is received within 12 months from the date of death. I don't know why 12 months. Is it that after 12 months, if you receive the money, the death becomes no death? Is it because after 12 months, the family stops requiring the sum of money? And how would the family of a deceased person have any control over the money that the family would receive? All of us are reading in the newspapers, Supreme Court of India is taking steps to ensure that state governments release the money, and governments are not releasing money. I read in the newspaper today, checks of Karnataka government are bouncing, government check bouncing. Now, if this is the situation, to say you receive the money within 12 months, no tax, because you did not receive the money within 12 months, tax. I fail to see the logic, but that is the proposal. Even if the amount is received by an SSC employee from the employer under section 17, an amendment is proposed that it will not be treated as a perquisite. With this, let me go to now a small but a significant amendment creating or likely to create a huge complication, and that is under section 68 of the Act. All of us are aware that under section 68, cash credit is taxable. Cash credit being a sum of money which an SSC receives during the previous year, which he cannot satisfactorily explain. Now, the fact of the matter is that law otherwise was that I am not required to give source of a source. So long as I prove identity, capacity, and genuineness of the transaction, my job is over. And if I receive a sum of rupees 50 lakh from A, I need to only show the credit worthiness of A, nothing beyond that. Also, the fact of the matter is that this provision was grossly misused, especially by layers of companies all originating from Calcutta, and unaccounted sum of money running into a few thousand crore of rupees entered the economy on account of layered transaction. Therefore, the law was amended in the year 2013, whereby in case of share capital received by other than a listed company, the obligation of the company was not only to prove genuineness of the transaction from the perspective of the recipient SSC, but also from the perspective of the depositor or giver of money or the shareholder. Now we are moving a step forward, or do I say a step backward? Now the proposal is that whenever an SSC receives a sum of money, he will have to prove not only his source, he will have to prove source of the source. The proposal is that where the sum of money is credited in the books of account of the SSC, then SSC has not satisfied onus cast on him to prove genuineness of the transaction unless the creditor also offers an explanation as to the nature and scope source of money to the satisfaction of assessing officer. So now, let's say I receive a sum of rupees 50 lakh from A. By way of loan, I will also have to prove from where A got the money. And therefore, if A in turn has borrowed from B, whether B had enough resources to give money to A. So A and B, the next step, both SSC must prove. Now please consider the practical problems. I receive loan today. It's a loan of 1 year. Within 1 year, the loan is repaid. By the time my assessment comes up, there is no loan. The creditor is not in my books of account. I may have no contact with the creditor. Or even if I have a contact, why would creditor be required to open his books of accounts to me and show that, look, these are the ways in which I have generated the funds? It would be, in a large number of cases, very, very difficult for the SSC to prove source of a source, because creditor may not be prepared to oblige unless the creditor happens to be a member of family or a close associate. If you take the language of the proposal to its illogical extent, if I borrow rupees 50 lakh from State Bank of India, the law can expect me to prove from where State Bank of India got money, because it makes no exception for any bank, credit institution, financial institution. If you receive loan, prove the source. So I receive rupees 50 lakh from State Bank of India, and there is, let's say, a funny officer, he says, prove source of a source. If I go to State Bank of India, they'll throw me out. They'll say, you have taken rupees 50 lakh from us, return the money back to us, we don't want to talk to you. But this is what the language of the section is. Let's go to the next position. In relation to share capital, there is an exception in relation to shareholder being a non-resident. In case monies are flowing in from a foreign jurisdiction, no inquiry of source in source of source. For this amendment, there is no such exception, which would mean SSC receives, let's say, rupees 20 lakh as loan from a gentleman of Dubai, where there is no income tax. SSC will have to point out all details of that Dubai-based gentleman to show he had enough sources to make the payment, failing which it will be added in the hands of the SSC. So whereas I appreciate the need to bring in some legislation to curb the menace of bogus cash credits, the way in which the provision is being brought up probably is going to create far more serious complications. The next proposal is insertion of section 79A. Now, this is again an interesting provision. In a large number of cases, government found that at the time of search, requisition or survey, lot of undisclosed income is found. But then, and if you recall, such undisclosed income may result into huge liability. But then government also found that in some cases, SSs were not paying taxes wholly or in part because they had business losses, unabsorbed depreciation. So therefore, they were legitimately setting it off against losses and depreciation. So now this income, which I'll immediately explain, is being immunized from being write-off, set-off. So what is the provision? Notwithstanding anything contained in the Act, where consequent upon search under section 132, requisition under section 132A, or survey under section 133A, other than TDS survey, SSC is found to have an income which will be an undisclosed income, no set-off of any loss brought forward or otherwise, or unabsorbed depreciation shall be allowed. So this undisclosed income will remain as undisclosed income, will not be permitted to set off against losses, etc. Please mark, current depreciation is not covered here. So you can't set off unabsorbed losses, current losses, and unabsorbed depreciation, but current losses you can still set off. Probably it's a legislative error. I would not be surprised by the time bill becomes an act, they may correct it. Now, what is undisclosed income? Money, bullion, jewelry, valuable article or thing, or entry in the books of account, or documents, or transactions which are found during search, survey, or requisition, which have not been recorded in the books of accounts kept in the ordinary course of business, maintained for the purpose of normal income, or any income of the previous year represented by entry in the books of account or documents for the year, but which are found to be false, and their falsity could not have been noticed but for the search or survey. So the proposal is, in search or survey, we catch hold of the books, we will go through the books. If there are entries in the books which are false, income in relation to those entries will be treated as undisclosed income. Once you put it as undisclosed income, no benefit of set off of past present losses or unabsorbed depreciation. This is going to be step one. I would not be surprised if next year they say that this undisclosed income will be taxed at 60%, because all these kinds of separate incomes initially were kept just separate, and later on, like section 115 BBD, etc., they were all put in at 60%. Therefore, this is one provision which is again going to create litigation. We had dividend stripping, which was curbed statutorily. We had then bonus stripping of units, which was curbed statutorily. But bonus stripping of shares was still kept open. And therefore, whenever a good company would declare bonus issue, there was a flurry in the stock market to buy shares, come bonus, get the bonus, sell away stock immediately thereafter on X bonus basis, old shares, and claim losses. Now, amendment is being proposed that the provision of dividend stripping would also apply to all securities. So bonus stripping would also not be permitted. So if you acquire share 3 months before the record date and sell within 9 months after the record date, if you suffer a loss, the same would not be allowed to the extent of your income otherwise. One more important procedural amendment, which is in provision of section 139. We are aware under section 139(5), a return can be revised. However, the period of revision is being scaled down from time to time, 12 months, 3 months down within the year. The government also wants to have additional income tax. So in a way, a new proposal is being suggested for the purpose of getting some additional tax and also giving some relief to the SSC. We have now a scheme of updated return. What is an updated return? Anyone can file an updated return subject to exceptions, which we'll immediately see, whether or not he has filed original return of income. In other words, I was required to file return of income, I did not file, I can file updated return, or I have filed the return of income and I can still have an updated return of income. There is some complication over here, I'll come to it a little later. Now, this return will have to be filed within a period of 24 months from the end of the assessment year. So assessment at 21-22, we have a right to file updated return up to 31st of March 2024. 3 cases or the 3 situations you are prohibited from filing updated return. The whole scheme is a one-way traffic. Why do I say one-way traffic? Immediately you will realize. First, you are not permitted to file updated return to claim loss. If you have not filed loss return, sorry, it's your problem. Now you can't file updated return. 2, you are not permitted to file updated return to reduce income already returned under section 139(1), 4 or 5. So I filed a return of income declaring income of rupees 50 lakh in any of the returns. Now I realize that as a matter of fact, my income is not 50 lakh but 40 lakh. I can't file updated return. If you have missed the bus, you have missed the bus. Third, you cannot file updated return if it results into a refund of any taxes paid by you pursuant to a return already filed. Now, what would happen? If I have filed return of income, I would have claimed refund. But suppose I have filed a return of income of rupees 30 lakh, I have paid taxes, then I realize that I have forgotten to show income of rupees 2 lakh, but on that income of rupees 2 lakh, TDS is affected, and I have also forgotten to take credit of TDS. If I file updated return, my income goes up, but because of TDS credit, some tax will have to be refunded. Sorry, you can't do that. So updated return is meant to take care of only those situations where you end up paying additional tax. If you are not required to or entitled to pay any additional tax, you have no right to file updated return. This is situation number 1. So it's a one-way traffic. Pay tax, payable tax, go. Refundable, no, you can't get it. There are certain SSs who are ineligible. Even if they want to file updated return, they are ineligible. 1, where there is a search or a survey. 2, where there is a requisition. This inability continues in the year of search or survey or requisition plus 2 more years. Or where SSC has received a notice from the assessing officer that at the premises of a third party when the search took place, any money, bullion, jewelry, valuable article or thing belonging to SSA was found there. Or fourth, when SSA has received notice that when a search took place at the premises of a third party, any books of account or documents are found in relation to SSA, meaning thereby incrementing documents are found. In those 4 cases, SSA cannot file updated return. The problem is in the third and fourth situation, SSA cannot file provided he has received notice to that effect. Now, under which section notice will be issued by the AO? There is no provision under the law whereby SSA receives any such notice. Be that as it may, the section says you can't file the updated return. Apart from this, there are 5 other situations where you cannot file updated return. 1, there can't be updated return of an updated return. In other words, there can't be second updated return. Or, and this is a problem thing, where assessment or reassessment proceedings are pending or completed for that year. Now, please mark, what is the prohibition? Where assessment proceedings are pending or completed for that year, I can't file updated return. Now, we saw it in the beginning that I have a right to file updated return even where I have already filed a return. Now, once I file the return, either it is pending or it is completed. How do you reconcile the two situations? In the first part, you say, even though you have filed original return of income, you have right to file updated return. In the second part, you say, if your assessment is pending or completed, then you are not permitted to file updated return. The only way I can reconcile the inconsistency is I have filed return of income. It might have been accepted under section 143(1). Therefore, it is not pending anymore. And there is no assessment under section 143(3) because my case is not picked up for scrutiny. Probably that is the only small window you will have. Otherwise, if you take a view, pending will include from the day on which it is filed till it is concluded, and concluded means it's concluded in a case where return of income is already filed once, this scheme itself will be inapplicable. So they will have to come up with some explanation or clarification. What is the meaning of the term pending? You are not permitted to file updated return where an assessing officer has reason to believe that you are connected with some SAFEMA, Binami, PMLA, Black Money Act violation, and he has so informed you. You are not permitted to file updated return if information in relation to you is received under section 90 or 90 capital A, where countries share in relation to the tax evasion information about SSEs. And you are also not permitted to file updated return where prosecution in relation to that year is filed against you. Let's say you are permitted to file updated return. What is the amount which you are required to pay additionally? The law says you are required to pay, if you file updated return in first 12 months, you have to pay 25% extra. If you are filing updated return in next 12 months, you have to pay 50% extra. I did not say extra of what, for a reason. It is 25% or 50% of tax payable plus interest. So interest for not filing return of income in time will have to be computed under section 234A and 234B. Accordingly, those sections are also being amended. Let's say tax is rupees 20 lakh, interest is rupees 6 lakh, total comes to 26 lakh. If you pay within 1 year, 6.5 lakh, 25%. If you pay in the second year, 13 lakh, 50%. So now this is a provision which also carries liability to pay additional tax on interest. I can understand interest on tax. This is tax on interest. That's how this provision will operate. And section 153(1)(a) is being inserted to provide that such return will be assessed within 9 months from the end of the financial year in which the return is filed. Faceless assessment section 144(b), which has created huge controversy and huge litigation, whole section is being replaced. There are minor changes which should not detain us at this stage because we are not discussing only faceless assessment. I will therefore not take more time except to point out two major amendments. One, it was always a matter of debate from the revenue side, that even though you may ask for opportunity of personal hearing, should you be given that or not? Revenue was taking up a position that giving of opportunity of personal hearing is a matter of discretion of the commissioner. Now it is statutorily being provided that if an SSA asks for personal hearing, he shall be granted as a matter of course. The second change that is being made is section 144(b) subsection 9 provided that if there is a breach of the provision of this section, one year requirement of this section, the assessment order would be void. A large number of orders would turn out to be void because of the fact that on a wholesale basis, the provisions of this section were committed in breach. So now, how do you solve the problem? You solve the problem by saying they are not void. So subsection 9 is sought to be removed retrospectively. So even if an assessment is framed in breach of the requirement of section 144(b), which would render order void at the relevant point of time, now because the provision as to the order being treated as void is removed, that order will stand. Then we have now significant amendments in section 148. If you recall, last year I had discussed broadly the scheme of section 148. Assessing officer would have right to reopen only if he has information in his possession which would show that income on which SS is liable to pay tax is escaping assessment, etc., etc. The law under section 148 envisages two situations when income is escaping assessment, and one more situation where income is deemed to have escaped assessment. Now in all the three there is an amendment. One, the first clause when income is escaping assessment is when the law says any information is flagged in the case of SSC for the relevant year in accordance with the risk management strategy formulated by the board from time to time. So if any information is flagged, which means it pops up, then it will be a case for reassessment. Now the word flagged is being removed. So information need not flag. In other words, if department has information which somebody can search, if assessing officer can locate, not that information may be picked up. See, the difference is, as we know, there are two kinds of notifications, push or pull. In some cases, you have to ask for notification. In some cases, it's automatically received. Either to it was flagged, meaning thereby it will be popped up so that assessing officer can see. Now it is not flagged. Assessing officer would have right to see any information anywhere in accordance with risk management strategy and pick up your case. This may not be very important. What is more important is the second way in which the case can be reopened is, if you recall, last time I had said the provision was if there is a C&AG audit objection and it is not, C&AG is not accepting assessment to be correct. I had said last year that C&AG audit pertains to only government entities So we are not likely to be worried about this. Government has realized that C&AG audit has a very, very limited scope. And in a way, it completely displaces their internal audit division. So now there are 4 amendments, not 1. 4 situations are now giving right to reopen. 1, if there is an audit objection. 2, if information is received against the SSC under section 90 or 90A, that is in relation to international transaction. 3rd, if any information is received by an assessing officer under the scheme notified under section 135A. Under section 135A, there is faceless collection of information scheme. Essentially, it's a scheme whereby information will be shared by various government departments inter se. So if now under section 135A, any information pops up, your case can be reopened. And the 4th, where any action is required to be taken pursuant to an order of the court or tribunal. So if the court or a tribunal requires a particular case to be redone on account of IBC, resolution plan or otherwise, or on account of amalgamation, etc., this will be regarded as a case where income has escaped assessment. In the second part, where income is deemed to have escaped assessment to the knowledge of the assessing officer, was a case of search and survey. But in survey, 2 kinds of surveys were excluded, 133A2 and 133A5. Event-based survey and TDS survey. Now, event-based survey is taken out. In other words, if there is an event-based survey, it would result into 3 years reopening under section 148. It's only if it's a TDS survey, you will not suffer reopening for a period of 3 years. There's one more, again, major amendment. Under section 149, you can reopen the case for up to last 3 years. The exception provided from 3 to 10 last year was where assessing officer has in his possession books of account or document or evidence which would reveal that income chargeable to tax represented in the form of asset is found to be in possession of the SSC. Some of you would recall, while discussing this provision last time, I had said the language uses asset. And therefore, even though assessing officer is in possession of information, that let's say marriage took place in the family of the SSC 5 years back, where cash amount of rupees 2 crore was spent, because it does not get reflected in an asset, no case is available for reopening. I don't think they hear me on YouTube, but now they have amended the law. Now 3 situations, asset yes. Second situation, if assessing officer has in possession, etc., information to show SSC has incurred any expenditure in respect of a transaction or in relation to an event or occasion. So if there is an expenditure in excess of rupees 50 lakh in case of event, transaction or occasion, even now revenue can go back up to 10 years. Or the third situation, if there are entries in the books of account which would show undisclosed income in excess of rupees 50 lakh, again revenue can go as back as up to 10 years. Question would arise, how do you really interpret this provision where the expenditure is spread over for more than 1 year? Marriage is in the month of, let's say, February. Some amount is spent in between January, February, March. Some bills were outstanding. They were paid in the month of April, May. So an amount of rupees 80 lakh is incurred. expenditure 80 lakh is incurred, 40 lakh in year 1, 40 lakh in year 2, no individual year exceeds rupees 50 lakh, can the case be reopened? So subsection 1 capital A is being inserted, which clearly says that if the event, occasion, or transaction pertains to more than 1 year, then case of all the years will be reopened. Therefore, in this case, though individually in no year it is in excess of rupees 50 lakh, both years will be reopened. Again, interesting question would arise. Would this be in relation to the very event or to independent events? And how do you decide two independent events? There is marriage of son, there is a marriage of daughter. They are not taking place at the same time. Let's say there is time gap of 6 months or a year, and some expenses are common, some expenses are not common. One falls in year 1, another falls in year 2. Would it be one event or would it be different events? These are all matters of fact. I am not saying that if they are different events, even then it will be covered. Some amount is spent in year 1. In second year, there is no amount, no expenditure incurred. Ornaments are purchased in year 1 and marriage takes place in year 3. Year 1 can be reopened, year 3 can be reopened. But if ornaments are purchased for the marriage of son and the expenditure is less than 50 lakh and marriage is, son has run away and there is no expenditure on his marriage thereafter. And the daughter, the marriage is celebrated with a cash expenditure of rupees 40 lakh in year 3, I would take a view this provision really would not apply. But these are interesting issues which we'll see in the years to come. Now there is one provision which is Income Tax Act. You find provisions which are made interesting, apparently SSE friendly, and their only purpose is to make act look user friendly. Nobody uses those sections. There is a chapter 14A, repetitive appeal, where an SSE can avoid going in appeal if there is a repetitive appeal in relation to his own case. The chapter is introduced in the year 1984. In last 37 years, I have not seen more than 3 SSEs taking advantage of it. Now there is an improvement in the chapter that if case is decided in favor of SSE in some case which is pending before the higher authority, and if SSE, the other SSE agrees that I don't want my appeal to be carried out, I'll wait for the other SSE to finally adjudicate. There will be no repetitive appeal. I'm not taking your time. It's not worth it. Essentially, there is a provision whereby you can avoid department. You can prevent department from preferring appeal against you if you agree that you agree to be bound by someone else's order. Amalgamations and demergers have created a lot of problems for the revenue. Courts have taken a view that unless the assessments are framed on the right entity, you cannot really sustain the assessments. Maruti Suzuki, Supreme Court took the view that post amalgamation, if any assessment order is passed against the transferor company, it's a dead company, nothing can be done, the assessment is invalid. So now there are 2 proposals which are being suggested. In case of every business organization, reorganization, and business reorganization defined as amalgamation, demerger, or merger of businesses. Assessments made during the course when the proceedings for business reorganization are pending shall be deemed to have been made on the successor. So they would not be treated as null and void. Similarly, under section 170 capital A, if during the course of pending proceeding, let's say A is getting merged into B, B is the successor. When B has during the course of reorganization proceedings filed return of income, once reorganization is over, B is bound in law within 6 months to revise his return to capture reorganization. In other words, if B is in receipt of any income from A by virtue of amalgamation because of appointed date, he is bound to necessarily amend his return of income. Section 194 IA, and this is one provision which I believe is completely senseless. 194 IA, we are aware, says that in case of sale of immovable property, the buyer will have to deduct tax at 1% from the sale consideration. Good enough, I have no problem there. Now 1% from the sale consideration. Proposal is 1% from the sale consideration or section 50C value, whichever is higher. So let's say sale of property takes place at rupees 5 crore. Property goes into the stamp before the stamp authority valuer, and the registering of authority says it's not 5 crore, it is 6 crore. On rupees 1 crore, stamp duty would be paid or would be disputed, so on and so forth. But buyer is told, you have deducted TDS of 5 lakh, you should have deducted tax TDS of 6 lakh. Now, by that time, the vendor would have gone away. Why is vendor thereafter concerned with the buyer? He has sold away the land. He has received the consideration. Purpose of 1% is not to collect revenue. Percent of 1% is to ensure that no transaction goes unnoticed, so that it will be picked up in assessment. How much revenue government will generate by taking additional 1% on the differential sum between Jantri value and the document value? 99% of the time, people do not execute document at a rate below Jantri value. 90% of time, they do not execute document at a rate above Jantri value. But that's a different story. Now you are picking up that 1% case where Jantri value is found to be higher, and now you are telling him there is that 1%. I thought this is something which could have been avoided. It is not going to generate revenue, and it is going to generate unnecessary litigation. Similarly, one provision is being introduced, section 194R. This is again a provision which is going to create more complication. Again, in relation to those freebies, medical freebies or similar things. If a person provides to another resident any benefit or perquisite, whether convertible into money or not, arising from business or exercise of profession, then he will have to deduct taxes at source at 10%. Whether the benefit is in cash or in kind. If it is in kind, before handing over that kind, the gift, he will have to recover 10% and pay over to the government, or he will have to gross up. So effectively, let us take a situation, and let's for the time being spare pharma sector. Let's say FMCG company introduces a scheme for its distributors that whoever reaches a particular target will take them on a tour to Kashmir, but whoever reaches target above a particular amount will take them to, let's say, Mauritius. This will be regarded as a benefit or a perquisite, and therefore 10% of the amount spent by the company on each distributor will have to be subjected to TDS. Now, if the either you recover from the distributor or pay, or you add on gross and pay from your pocket. But unless you do that, you would not be in a position to avoid 194R obligation. The downside is, because it will be reflected in the annual return of the TDS of the SSE, it will automatically pop up in the hands of every distributor that here is a distributor in relation to whom I have spent rupees 2 lakh for Mauritius tour. So far, all these tours were escaping income tax because no distributor was declaring such benefit as taxable benefit. Now, all these people will have to necessarily declare this income because that will be reflected in the TDS statement. One last major and series of amendments in relation to charitable trust. In fact, there are so many amendments that one wonders as to whether you will require one full-fledged seminar. Probably yes, after the bill is made into an act. The finance minister says, I am bringing amendment in 3 categories. One, for effective monitoring and implementation. Second, for removing inconsistency between section 1023 and 11 and 12. And 3, for clarity of taxation in certain situations. Let's go to each one of them. One, effective monitoring and implementation. Today, every charitable trust having income in excess of not liable to tax before section 11 and 12 deduction has to maintain books of account and get them audited. I don't know why. Now the government says you will have to maintain books of accounts and documents as may be prescribed, in the manner prescribed, and at the place prescribed. Now, if you already have books of accounts audited, what is further to be prescribed? But nonetheless, they say we will now prescribe what you should have. Then the second set of amendment is this. Under section 13(1)(c), if a charitable trust permits a related party under section 13(3) to enjoy the benefit, that's a breach of section 13, which will have its own consequences. What are the consequences is a matter of some debate, whether it would result into losing of exemption on the whole income, or is it only that part which has been so misused will be subject to tax, is an issue or was an issue in controversy. Now the proposed amendment is one, there are 3 amendments. One, if there is a benefit which is being given under section 13(1)(c), then number 1, it will be taxed in the hand of the trust, but only that income will be taxed, not the gross income or the total income. 2, that income will be treated as a specified income. What will happen to specified income? It will be taxed at the maximum marginal rate. And 3, if there is some breach of section 13(3), in year 1, if there is a breach, there will be penalty equivalent to 100% of the breach. And if there is a breach in any subsequent year, it will be penalty equivalent to 200% of the amount of breach. Which means, let's say the reasonable salary is rupees 5 lakh per annum, and you have paid rupees 15 lakh per annum, you have paid additional sum of rupees 10 lakh. Number 1, 10 lakh will be, and only 10 lakh will be the taxable income of the trust. B, it will be taxed at 30%. And C, trust will also have to pay penalty of rupees 10 lakh if this is the first year. But if it is a repeated event, you will have to pay penalty of rupees 20 lakh. Commissioner of Income Tax is given very wide power to cancel registrations, and this is now going to be done on a very large scale. First, let us find out at the instance of assessing officer, where during the course of assessment proceeding, assessing officer comes to know or comes to believe that the SSC trust has carried out activity not in accordance with its objects, it must report the matter to commissioner. Commissioner will hold inquiry, and after holding inquiry and after hearing the trust, he may as well cancel the registration. Because this is going to take some time, the time between the date on which assessing officer makes reference till the time he receives direction from the commissioner will be excluded for the purpose of limitation. This is one. But independent of this, commissioner also has now power to cancel registration in a series of cases. Earlier, the law was he could cancel only if activities are not genuine or that they are not being carried out in accordance with the object of the trust. Now there are many situations which entitle him to cancel registration. One, income is applied other than for the object of the trust. Two, the trust has income from business or profession which is not incidental to the object of the trust. Three, the SSC has spent money for private religious purposes. Fourth, and this is in my view going to create a Pandora's box. If a trust is registered under the 1961 Act, it has applied its income for the benefit of any particular religious community or caste. Now, all religious trusts spend money only for religious purposes. Let's say if there is, and I'm just taking as an example, if there is a Jain trust which caters to giving food to all needy persons, but if the revenue believes that only Jains are permitted to take advantage of this particular charity, you are hit. If in a Gurudwara only Sikhs are being given the benefit, you are now hit. I understand secularism, I understand the principle behind it, but in a large number of cases, on a ground level, this may be difficult to be observed. You may find that a trust, a religious trust, is dedicated to a particular religion only. In such a situation, you are likely to lose registration if the revenue takes up a technical view of the whole matter. And if the trust commits breach of, look at the irony, breach of any other law which is likely to affect the object of the trust. Now, again, take illogical extent. Trust is a hospital trust running a hospital, but the building plan of the hospital is not approved by the municipal corporation. Now, if building plan is not approved, maybe the building may at some stage theoretically be demolished, or you may have to modify the building. But because you have committed breach of municipal law, which is required to be observed for the purpose of object of the trust, you might be told that I am cancelling your registration. I do not know what is it that they are trying to achieve by these kinds of provisions. And therefore, as I said, this is one set of provision which gives huge power to the commissioner, and you will have to be extra cautious to ensure that every law is observed by you both in letter and in spirit. You have a right to accumulate the amount of income, 85% you have to spend in this year, or you can accumulate for 5 more years. You are required to spend in 6th year. Now the law is being amended, you will have to do it in the 5th year. Application of income will always be on cash basis. So if even if you are maintaining mercantile system of accounting for the purpose of application, you will only have to go on cash basis. If by virtue of section 13(8), because you are committing breach of section 215 proviso, it is held that you are not entitled to exemption, your income will be taxed on commercial principle. Good enough. But you will not get deduction. What? You will not get deduction of expenditure incurred from the closing balance of corpus of last year. So if I have corpus of rupees 5 crore at the end of last year, and if I lose exemption in next year, up to rupees 5 crore, I would be told you have spent out of corpus, you don't get deduction. I do not know what is the logic. Or if you have spent money by borrowing or by loan. Now, probably they believe that next year you may again be a charity, in which event you will claim borrowing and loan as an application, repayment of borrowing or repayment of loan as application. But then I may never become charity. I may always thereafter remain non-charitable institution. But even then you will not get deduction, or you will not get depreciation on assets which you have claimed as an by way of application of income, or you will not be permitted to make any contribution or donation. But if I am not a charitable institution, even if I make donation, I am not going to get deduction. But again, I am told I will not get it. Section 40 and 40A will apply. So all disallowances under those provisions will also apply. Just as section 13(1)(c), if 13(1)(d) there is a violation, then to the extent of violation only income will be taxed, and that too at the maximum rate of 30%. Section 80G, all those trusts which are entitled to 80G, religious trusts, if they receive any money for restoration or repair, they would be entitled to claim it as corpus, subject to some minor conditions which are not really material. With this, all major amendments come to an end. I'll now take 2-3 minutes discussing minor amendments. Section 43B is being amended to exclude deemed payment where the interest is being converted into debenture. Section 80I(a)(c), the starting date for startup is being extended from 2022 March to 2023 March. Section 115BAB is being amended so that you can start manufacturing right up to 31st of March 2024. Concessional rate of tax in relation to foreign dividend at 15% under section 115BBD is being withdrawn, so you will have to pay tax at the normal rate. There is a minor amendment in relation to the section 248 is being removed. Instead, you will have to pay tax, apply to AO. If he rejects, you have a right to prefer appeal. As I said, there are many more amendments which I have left out, but I believe that they are either too irrelevant for us, or they are relevant only for a specified sector. Like if you buy Air India, and if you change the rate of tax of Air India structure, you will have some tax issues to discuss. But none of us are buying Air India. Tata has already bought over. So I did not discuss those issues. With this, let me thank you all again for enabling me to share my thoughts with you. Thank you very much.
I would now request CA Sarju Mehta, Vice President, Chartered Accountant Association, to propose vote of thanks.
Hello, friends. After the mesmerizing voice of Sri Saurabh Bhai, this is my voice, Sarju Mehta, and I am here to extend vote of thanks. Friends, at the outset, first time we are thankful to Sri Saurabh Bhai for. We are thankful to Senior Advocate Sri Saurabh Bhai Soparkar sir for excellent analysis of Union Budget 22. Friends, it is said that a good advocate is who reads line in between the words. To add to this famous quote, we should now say that a noble advocate is who even teaches to his fellow professionals how to read in between the lines. Saurabh is one such noble advocate who always explains to all of us how to read in between the lines. So once again, on behalf of all of us at CA Fraternity, I extend our heartiest thanks to you, sir. At this point, I take opportunity to say thanks to entire management committee team of Ahmedabad branch, making proud to all CAs of Ahmedabad for the recent awards of Best Branch Award and national and regional level too. I am also thankful to all of you for your presence at today's budget seminar. Friends, we wanted you to be present physical at this hall, but because of this pandemic situations, we are not able to call you at the place. But still, we know and we hope that the mesmerizing voice of Advocate Sri Saurabh sir has not let you down, that you are not here. Thank you, all of you.
ગ્રીન પડદો હટાઈ દેવા